The slide is visible. Can you see the slides? Hello. Hello. Harsha,
Yes, sir. Yes, sir.
you can see my slides?
Yes, sir.
Okay, good. You had your lunch today?
Yes, sir.
What did you have?
Vegetables and chapati.
Okay, okay, good, good, good. Okay, God bless you.
Thank you.
Ah, just 1 second, I have to. I don't know, so many wires are here. I don't know which one. Okay. Mm, Surendra Kumar, Surendra is here. Kishore Chandra, Hari Kishore. Okay.
Good afternoon, sir. Good afternoon, everyone.
Hi, hi. Good afternoon. Good afternoon, Surendra.
Good evening,
We have
sir. Good
yeah,
evening.
yeah.
Good
Good
evening,
evening.
everybody.
Good evening. Good afternoon. Everything to everybody. Okay. So far we have completed DCF, both dividend and cash flow. We'll start today. This is a relative valuation. Mostly this is being used by the traders. Okay. This is being used by the traders. Yes, investment analysts do use relative valuation, but to a limited extent. Okay. This mostly used by short-term investors. You can call it the traders. Of course, this is based on the fundamental aspect of the company. Okay. Now, in discounted cash flow valuation, the objective is to find the value of asset given their cash flow, growth, and the risk characteristics. Isn't it? We have seen cash flow, growth, and risk characteristics in terms of equity, cost of equity. When you do valuation of the company, you take WACC, weighted average cost of capital. But in a relative valuation, the objective is to value asset based on how similar assets are currently priced in the market. Okay, fine. While multiples are easy to use and intuitive, they're also easy to misuse. Okay, clear? Therefore, it's very easy to use. Most of the traders they do use. You need very few assumptions or few variables. Okay. The components of relative valuation to value assets based on relative basis. Prices have to be standardized. You see now here everything you will say we call it price relatives. Numerator is always price, denominator is all the fundamentals. Price to earnings, price to EPS, price to book value, price to sales, price to EBITDA. Okay. Means the numerator goes, the price takes care of the numerator. Means basically what it says that how market responds to company fundamental. Price to sales, price to book value, price to okay, EBITDA, okay. Means how price or the market responds to company fundamentals. But what do you need it? Because suppose you are doing valuation of two companies, one is very large company, another is small company. Their sales will be different, their earnings will be different. But the moment you say price to sales, price to you are trying to what? You are trying to normalize. Irrespective of large or small or medium company, once you say ratio, price to sales, big company, price to sales, sales may be low, but the price will be low, then see how the price is responding. Okay, accordingly, adjustment. Therefore, it looks it becomes in one sense it becomes easier to compare between the two companies, how the price is responding to company fundamentals. Once you put this price divided by all the multiples. The second is to find similar firms, which is very difficult. Okay, to do since no two firms are identical, and firms in the same business can still have different risk, growth, and cash flow potential, isn't it? Now, use of relative valuation is quite widespread. Mostly all the traders, short-term investors, they do use. Okay, and most equity research firms or reports and many acquisition valuation are based on multiple, such as price to sales, price to book value, price to EBITDA. Okay, Clear? What is the reason for this popularity? First, valuation based on multiples and comparable firms can be completed with pure assumptions. Unlike in DCF, so many things you have to calculate, the payout, the that, all the so many things, dividend, leverage, all these things, pure assumptions. We'll see how many. And they are far more quicker, quickly you can do it than discounted cash flow valuation. Second, this relative valuation is simple to understand and easier to present to client and customers than discounted cash flow. The growth rate, all these that, no, this is more complex. Of course, that is used for strategic alliances. Mostly DCF is used for long-term investment purpose. The investor, those who are really investors, not traders. Invest means those who like to buy it, hold it, okay, for 5 years, for 10 years, clear, long term. Any strategic alliances, mergers or acquisitions, they do use DCF method. But those who are traders, okay, short-term investor, they use this relative valuation. And finally, this relative valuation is much more likely to reflect the current mood of the market because you are taking numerator is the price divided by fundamentals. What is the current mood of the market? How market is responding to company fundamentals? Clear? Fine. To measure the relative and not the intrinsic value. And what are the pitfalls or the limitations? First, the ease with which relative valuation can be put together, that is pulling together a multiple and group of comparable firms can also result in inconsistent estimation of value, where key values such as risk, growth, cash flow potential are ignored. Because two companies that if you don't do this, okay, cash flow method, because cash flow takes care of the risk, growth in the asset, okay, because risk is not constant, it's going to change, okay, it's quite dynamic. The growth may be changing. Those things are not considered here in a relative valuation. Second, the fact that the multiple reflect the market mood because numerator is the price also implies that using relative valuation to estimate the value of an asset can result in value that are too high. If the price is too high, means price to sales will be too high. Because as you know, market can be rigged. Because of so many reasons, sometimes the market may not truly reflect the fundamental aspect of the company. Not sometimes, many times you will see the price may not truly reflect the fundamental aspect of the company. Not because something wrong, because the mood, because suppose now the war is going on, okay? The market may move in any direction. Okay, clear? Suppose any news comes from either from the government or the political region or whatever it is, then it will have a different impact than on the market. It means when the company is doing well, still the market may not be good. Sometimes company is not doing well, still the market is good. At that time, P price to earning ratio is very high. Clear? Right? This is the second limitation. Third, while there is scope for bias in any type of valuation, no doubt, the lack of transparency regarding underlying assumption in related valuation make them particularly vulnerable. It means assumption means what? It assumes that market is efficient or market is more or less this efficient. May not be very short term, but in the medium term or very quickly, it's semi-strong market, which need not be. Sometimes market may not be at all. It may be, you call it the market hypothesis. You would take semi-strong, fully strong, okay? Then you're no strong, okay? You can call it, okay? They know, okay, efficiency, okay? Efficiency. Sometimes the market may not, the stock price may not react at all to the company fundamentals. Sometimes market reacts, it may take some time. Sometimes market reacts very fast, quick, okay? That is fully strong, semi-strong, okay? And weak form. Weak form means when the market doesn't react or market stock price doesn't respond to company fundamentals. That's where the problem is, okay? The biased analyst who is allowed to choose the multiple on which valuation is based and to choose the comparable firms can essentially ensure that almost all variables can be justified. They can justify, okay, everything. Now here, and this can is going to justify. If you say multiples, your numerator you take, it means what you are trying to pay. The price means what market wants to pay, how the market is responding, what you are paying, okay, for the asset if you are buying that a price, and denominator means what you are getting in return, isn't it? Therefore, if you see entire your numerator, it depends on market value of equity, market value of the firms, okay, then the market value of special operating assets, so many things. And denominator is the fundamental revenue, earnings, and cash flow. Numerator is what market or how market is responding to that numerator to denominator to the company fundamentals. With this, we'll start fast. As you know, we'll have P multiples, price multiples, okay, price to EPS. Please, this price to EPS, and the P multiple will be the payout into 1 plus G. In case of, if you see the discount valuation, price is called DPS1 divided by K minus G. Isn't this is the stable growth? Okay, the constant growth. DPS1, that is DPS0 into 1 plus G, growth rate in dividend, which is nothing but growth rate in earnings, divided by K minus GN. Isn't it? Already we have studied this under discounted cash flow. Isn't it? But here, if you convert into divided by EPS, I'm not going to all the derivations which is not required for you. Okay, price divided by EPS nothing but P, and if you do EPS, this DPS1, the payout ratio into 1 plus GN divided by K minus GN. This is the constant growth of the constant growth using PE multiple. How to do the valuation? Okay, or you can, that's your payout ratio into 1 plus GN divided by K minus GN. Now let's take this one. This one company, the is ExxonMobil, you may be knowing. Okay, had EPS of 3.82 in 1992, and payout paid out 75% of earnings as dividend that year. Growth rate in earnings and dividend in the long term is expected. This comes from business analysis. 6%. Beta for ExxonMobil was 0.75 at the time valuation, and the T-band rate was 7%. Using the P price to earnings multiple, do the valuation. It's a constant growth model. Okay, the stable part, the constant growth. Can you tell me? Answer? Hello? Hello?
Yes, sir.
Yeah, tell me.
So what is the market risk here to
Vinay.
calculate the KE?
You take as a market is, I told you always in the exam also, you take 5.5 market premium. Market premium.
Okay.
R bar minus RF. The difference of market return over the risk rate. Always you take 5.5%. Even if not given in EC3, you assume always 5.5% is the equity premium or the market premium, and multiplied by beta, that will give the equity risk premium. Yeah. Yes. You are doing? Yes or no? Hello?
Yes, sir.
Yeah. What will the P multiple? the P ratio based on company fundamentals?
Sir, can you show that formula once, please, in the previous slide? The
Sorry.
payout ratio.
Yeah.
Yes, thank you.
Please carry all this formula to EC3. One or two numerical you may find very easy for you to score in the price multiple. You should not do any mistake in this numerical. EC3 will be total only 100% numerical mostly. You tell me what will the payout ratio? What is the payout ratio?
%74% is the payout ratio.
Yeah.
P multiple is coming around 5.30, sir.
5.30. How come?
Sorry, 15.30.
15.30.
15.30. Isn't
Yes.
it? Means 0.74 into 1 plus G. Growth rate is 6%. 0.75 into 1.06 divided by, and the cost of equity that is
11.1.
11.13 minus 6%, isn't it? Okay. Now this is your two stage. Okay, that is the constant growth. These are the two stage. Okay. Please, you can take photo of this.
Sir, one question here. What is the
Yeah.
purpose of EPS?
What is the purpose of
EPS value that was provided here?
Because this price to EPS is the formula, no? When you do
Okay.
here, when you do here, it's price to EPS, that is PE. It's called payout ratio into 1 plus G.
Okay.
Yeah.
Okay. We have to calculate that also. Okay.
Yeah. Now, in case of two stage growth, your EPS earning per share in year 0, that's the current year. Okay, today EPS. G is growth rate in the first maybe 5 years, 6 years, whatever they are. KEHG means cost of equity during high growth period. KEST, cost of equity in stable growth period. And payout ratio in the first n years. GN, growth rate after n years. Okay, it means after high growth period. And payout ratio n means payout ratio after n period, means after high growth period. And divide both sides in the EPS. Okay, 0. Okay, that gives you. Okay, did you write? Just take photo of this one formula. Okay, can I proceed?
Yes,
just
sir.
take a photo of this. Okay, now okay, this is the same. Okay, and this one example, because sorry, because this book is out of print, I cannot even share the soft copy. I don't have soft copy, it's the only hard copy. It's out of print. I've just scanned. I thought, okay, I'll just solve few numericals. This will be more than enough for you, I think. Estimate the P ratio for the high growth one. These are two stages. Assume that you have been asked to estimate P growth for the high growth. Following is growth rate in the past 5 years is 25%. Growth rate after 5 years means starting from 6th year is 8% with the stable growth. Beta during high growth period is 1. And the payout ratio in the past 5 years is 20%. When the growth is high, naturally the payout is low, and the payout growth rate after high growth from 25 it has come down to 8%. Now payout will be naturally will be more. Maximum earnings will be paid out as dividend because the growth is low. Risk-free rate T1 is 6%. You can take 5.5% as the equity risk premium, and the cost of equity is become the 11.5. The cost of equity is 11.5. What will the PE multiples?
Where is the EPS?
So this P means price divided by EPS is the PE. With the PE is equal to, okay, price to EPS is equal to this, the formula, no? Same thing somebody asked no question. This price divided by EPS is equal to this formula. That's what I told, no? EPS 0 into payout ratio into 1 plus G whole multiplied by 1 minus 1 plus G to the power N, 1 plus R to the power N divided by R minus G. This is the high growth period and the constant growth. Did you get it?
Yes, sir. Yes, sir. I'm getting it. Actually, I'm just looking at the formula. Like the
Ah.
EPS was provided, so we have to
Ah.
bring the EPS down here to calculate the remaining thing as the EPS is not.
Because when it's a P means already the E means that's the EPS. Price by EPS. Is this the formula which I've given you? This one. This one.
EPS is not given, right? EPS in the first year is not given,
EPS
right?
not required.
Not required.
Oh, EPS growth rate. The payout ratio already given, no? If EPS into payout, that will give DPS, no? Already payout ratio is given, no? If
So we have to
EPS is
divide both the sides of the equation by EPS 0. That is
no,
what is
no,
mentioned.
no. You Because already when the payout ratio is given, EPS into DPS, that will give you payout ratio. But already payout ratio is given here. Got my point? EPS into payout ratio, that will give you DPS, isn't it? Your DPS already given.
Yeah, as I think as Surendra or someone else, we just need to divide by everything so that it is P.
Yes,
Got it.
yes. During the high growth period, okay.
Sir, the required rate of return is constant for both the years.
Yes. Yeah.
Okay.
No,
As-
here, yeah, because yes, but the period 11.5. It was a payout ratio that of 20%, isn't it? 0.2 into 1 plus G, that is 1.25, the growth 1.25 into 1 minus 1.25 to the power 5 divided by 1 point, cost of equity is 115 to the power 5, whole divided by 11.5% minus 20 power 0.115 minus 0.25. That is your high during the high growth. Am I right?
I'm getting 82.57, but I'm not
82.
sure. Total, in total.
No, total should be 28.75.
I have to check the calculation again.
Okay, let's see. During high growth period, what you did during high growth period?
It is a
Yes,
payout of 20%,
that is 0.2
0.2
into 1 plus
to 1
G.
plus G
Yeah,
is
1.25.
1.25 into
into 1 minus 1 plus G power N, that is going to be 1.25 to the power 5
5 divided by
divided by 1 plus 1 point, sorry, 0.11, 1
no
plus 1.115 to the
yes
power
5
5 again.
And divided by
Then whole divided by 1.115 minus 0.25.
yes,
It's a
right.
negative things.
It's a negative.
1.425 in the growth period.
But you come to the second part, which is the constant growth. What is the constant growth? How to do?
So in the growth period, it is a 14.2%. Is that correct?
Sorry, I don't know that. Okay, individual I don't have. Go to the
Okay.
constant growth.
Yeah,
Constant growth.
1.427 is what I'm getting.
Yeah, 1.427. I got that. 1.427.
Yeah, 1.4.
1.
Growth period. Yeah,
Listen, gentlemen, this is the high growth period. We said during the
correct.
constant growth. Okay, can you tell me 0.5 first? Payout ratio after 5 years, 50%. No, that 0.5.
50%. Yes, 50% into
Into
1 plus that is
25.
0.08. 1.08 to the power 5.
1.25 to the power 5.
Sir,
into
correct.
1.08.
Into 1.08
divided by
divided by 0.115, that is KE minus 0.08
yes into
1 plus 0.115 to the power of 5.
5. Now this coming how much? Tell me total.
4.37.
How come?
No.
Answer says the book says the 28.75.
Sir, can you please show the formula, please? Yeah, thank you, sir.
So the first one, the The first one we got 1.427. When we say the first factor, is
Okay.
everyone in agreement
Yeah,
with that? The
I got
second
it.
one
I
I
got
got as 4.37.
Second
got
one?
4.37, but I will check. Looks like I am wrong. I'm not sure.
What is the numerator value that we have written?
Okay, numerator value I got 0.26. GN is 0.048. Let me see. It is a payout ratio of GN. GN. Yeah, I think I am right.
G is going to be, for me, I'm getting 1.64. The
It
numerator
is
value.
0.08 multiplied by 1 plus J13. J13 is G. G is
G is
G is
0.8. G is 8.
0.25. 0.25.
No, no.
0.25.
0.5. First to take the DPS is the 50%, no? Payout
50
ratio
percentage
50%.
it is.
Okay, payout ratio
DPS is
50%. You take 0.5 into 1 plus G, that 1.25 to the power 5 into 1.08
Correct. And it is
divided by
coming.
divided by 0.115 minus 0.08 into 1.115 to the power 5.
Yeah, 1.64, and then yes, I think total is 28.74.
Yes, correct. 28.75. Yeah, correct. You are right.
I'm getting 27.32. Somewhere to check like
Somewhat okay.
So the numerator is 1.64, denominator is 0.0. That one, the second part is 27.32,
Yeah.
and total is 28.74.
Yes, 28.74. Correct. You are right. Then come to the second one. Can you do this one? Second one.
No, I think other gentlemen are still doing the first one, sir.
That's the first one. Okay.
total is 28.74. That's right.
Did you get it, others? Other place.
So the numerator was 1.64, right?
I don't know how much numerator. Total is to come 28.7475. You can say. Who is saying? Who is saying?
Harsha, sir.
Harsha.
Sir. Yes, sir.
Harsha. Are you talking about the constant, the stable growth period?
Yeah,
Or
Stable, sir. Yeah, stable
yeah,
growth period. So
numerator is 1.64 for the second factor.
yeah, second factor 1.64, but my denominator is wrong. Sir.
Denominator is coming around 0.06.
0.060.
This is 0.115 minus 0.08 into 1.115 to the power 5.
Yeah, so can do it.
Over. Can I go proceed? Can you proceed?
Yes, sir.
Yeah. This is slightly not more variable details. The Eli Lilly, you know, this company, the one Fortune 500 company. The following, the estimation of appropriate PE ratio for Eli Lilly. The growth rate estimated for the initial high growth period from 93 to 97, that is for 5 years, was 9.81. This is the growth rate during high growth period, during which the payout ratio was expected to 53.78. And growth rate in the high growth period, okay, the growth rate in the high growth period was 9.81. Length of high growth period is the 5 years. Payout during high growth period already 53.78% already. Okay. Now the beta of Eli was 1.05. T-bond rate was 7%. And cost of equity, assuming 5.5 is the market premium, to be 12.78. Risk rate plus beta into market premium, 12.78. Expected growth rate during stable growth period, that is GN, is 6%. Payout ratio during this stable growth period, okay, growth rate is reduced, therefore the payout is high, 67.44. Now you calculate the PE multiple. Can you Harsha do it or others? You can do it. Yeah.
Yes, sir. Solving this.
Able to practice this after doing the, if you can practice once more, one numerical easily you can do it, which may be around 10 marks. You will get 8 to 10 marks. Good. One or two number. I think one I have asked, or one or two. I don't know. I have to check. And this also linked to also one more question is there in EC3 based on this.
What is the linked question, sir?
Linked. I will tell you, because now let me. I think
Okay,
we have one more session. No, I will tell you whatever questions I've asked, so that I will tell you how to prepare for EC3. Okay.
Yeah. If possible, please tell it today, sir, so that we'll have some time.
Today, where is the? I think your exam is when?
Exactly 10 days from now.
10 days. You then I will. Do you have any sessions? Scheduled session? Yes. No.
We'll just have one more class after this, sir.
That is enough. Don't worry. I'll do that at that time.
Okay.
Because some questions I have to remove. I have to add something. Okay. More or less finalize. I'll make sure the next session I will cover that.
Thank you, sir.
Sir, one request.
Please.
This three-phase calculation is intensive, sir. I mean.
Now, if you do some 2 years, if your 2 years is correct, I assume that you will be doing same thing, no?
Okay.
Correct.
No, even then, doing it in Excel is different from.
No. When I'm evaluating, I know. If you do 2 years, I know 2 years correct means, you know, maybe because time constant you cannot do it. Okay, don't worry.
Okay.
You see, my objective is to evaluate whether you know the things or not, whether correctness little bit here and there. It's okay, isn't it? Since you are not allowed to use Excel, I know. Okay.
Thank you, sir.
Thank you, sir. Sir, is the first part 0.0739?
Who is saying?
Harsha, sir.
Harsha, every time I'm saying I don't know the first per second. You give me the total is
Okay,
coming
okay.
is 11.72 total. Total is 11.72.
Okay, sir.
71 something. Okay, you can take it 11.72.
I just wanted to cross check
Mm.
with other people like Satya and Hari.
Mm.
Both of them, they were solving.
Yes, Satya or Satya Kailas, Mr. Surendra, Harsha, Kishore Chandra Pradhan. Acha, here Harsha. Acha, Harsha Gupta, Harsha Ajay Soni, the two.
Sir, what is the
Two.
total, sir? It is 11.71.
Yes, correct. You are correct.
Okay.
11.72 or 11.71. It's okay.
11.72. Yeah.
Correct. Okay. Can I proceed next?
Just for Harsha, the first part is 2.48. Second part numerator is 1.14 and denominator is 0.12. Second part total will be 9.23.
Okay, I first I got the first part I got 0.07. I'll do it again. Thank you. Thank you, sir.
Yeah. Next. Can I proceed next?
Yes, sir.
Okay. Can you do this one? Consider two companies with the same expected growth rate of 25% for the first 5 years and 8% after that, and with the same payout policy. Payout ratio in the first 5 years is 20%. Payout policy after 5 years is the 50%. But they've got different level of risk. Okay. Two company, both the others are same, but different level of risk. Beta of the first company is 1, beta of second company is 1.5. P ratio for the riskier firm will be lower than P ratio of the safer firm, isn't it? Can you calculate P of both? Naturally, the price to earnings with the risk company, the P ratio will be lower, isn't it? Than the safer company. The P ratio for the high risk company is lower than P ratio of the safe company or the low risk company. You will have two P. P of safer company where the risk is low, that is beta 1. And you can calculate P ratio of the when the risk is high, that is 1.5. Beta is 1.5. And you will find P ratio of high risk companies is lower than P of low risk company.
So we have to assume risk-free rate and market risk, right?
The market risk payment of 5.5.
Okay. And risk-free rate is 7%.
7% I am
Yeah.
assuming.
Yes. First cost of equity one is coming 11.5.
Sir, cost of equity, it is 12.5 because we assume 7%.
12.5.
1.5, sir.
Acha, you
12.5.
you tax 7%. Okay. Okay. Would have continued
Should we
6.
go for
Okay.
5?
Okay.
15.25 for second company.
Okay, 15.25. Same formula you will put it. Can I proceed second price to sales?
Yes, sir.
Yeah, okay. Now come to the price to book value. Okay, this is also one multiple which is used frequently. The market value of equity divided by book value of equity. Okay. Now, because fundamental side DPS 1 divided by K minus G, now you have to, okay, define the return on equity. Return on equity is equal to EPS 1, EPS 0 into 1 plus G divided by book value of equity 0. Now, if you do it, the net will come price to book value. Price to book value is equal to return on equity into 1 plus G into payout ratio divided by R minus G. This is the constant growth model. Okay. And your book value of 0 into ROE, or you can say ROE into 1 plus G. Right? Have you copied this? Now you the price to book value ROE minus GN divided by R minus GN. And you know G is equal to the growth rate. Earlier, no, ROE into retention ratio. G is equal to ROE into retention ratio, or G is equal to 1 minus payout ratio into ROE, isn't it? Isn't it? Yes or no?
Yes, sir.
Their price to book value this, the constant growth. With this, this one example, can you solve? This is a Volvo, the stable company working price to book value. At earning per share 11.04, Swedish kroner SEK in 2000, and paid out dividend as dividend of 7 SEK per share, which represents 63.41% of its earning, paid out to 63.41%. Growth rate in earnings and dividend in the long range expect to be 5%. Return on equity at Volvo is expected to be 13.66%. The beta of Volvo is 0.8. Risk rate of Swedish kroner is 6.1%. Now, can you calculate price to book value? Or I will show you. Now, this is the current dividend payout ratio is 63.41 here. 63.41. Gentlemen, please check here. 63.41. If it's paid out 7 divided by 11.04 is 63.41. Okay. And the earnings growth rate, everything already given here is 5%. Return on equity is given here 13.66. If the cost of equity is the risk rate plus beta, okay, into market premium, if you take it a 4% or 5, here I have taken the 4%, is 9.3. PB ratio based on fundamental ROE into payout ratio divided by K minus G. Return on equity is 13.66 into payout ratio is 63.41 divided by K. Okay. Your K is the 9.3, that is 0.093 minus G, that is your 5%. Clear? Yes or no? Hello? Hello?
Yes, sir.
Yeah?
Yes, sir.
This is the constant growth. This is the constant growth. Okay? And go to the next. The payout, okay, this same thing. The same thing is coming, okay? Now, these are two stages. These are two stages price to book value. Return on equity into payout ratio into 1 plus G. that the DPS 1 minus G to the power n divided by 1 plus R to the power n. And this is the constant growth, the stable growth period second, where G the growth rate in the first n years, G the first, and the payout ratio in the first n years, GN growth rate after high growth period, the growth rate that is the GN, and payout ratio after the high growth period, payout ratio that is the N for the stable part. And this is the formula for the two-stage growth. In price multiple, there is no three stages, mostly the two stages. Okay. Now this one numerical. Assume that you have been asked to estimate PV ratio for a company that is following characteristics. Growth rate in the first 5 years is 20%. Growth rate after 5 years, even that is stable growth period, that is 8%. Beta is 1, both the period. Return on equity is 25%. And the required rate of return 11.5. How? Like 6% is the risk rate plus market premium 5.5 beta 1. That gives you required rate of return cost of that 11.5. Payout ratio in the first 5 years is 20%. Payout ratio after the high growth period, the 68%, the growth rate has come down from 20 to 8, 68%. And the risk rate that is already 6% we have taken. Now, can you calculate PV ratio? 11.3. I don't know. These are complex here. The moving here and there. I don't know.
So can you show us the formula?
Okay.
Thank you, sir.
First, you take a return on equity, which is 25%, 0.25 into whole multiply. The numerator will be the payout ratio. Here, the payout ratio is the 20%. The first, okay, 20% into the growth rate is again 21.20. Again multiply by 1 minus 1.20 to the power 5 divided by 1 plus k, that is 11.5, 1.115 to the power 5. This is during the high growth period. Stable growth period is the payout, that is 68%. The growth has come down. 68% into 1.08, growth has come down, into 1.20 to the power 5. Okay. Divided by k minus g. K is 11.5 minus 8% into 1 plus k, okay, or 1 plus r, that 1.115 to the power 5. Isn't it? Yes or no? Hello?
Sir, in the second part, the payout ratio multiply by 1 plus g raised to n multiply by 1 plus g.
Gn means first 1 plus g means that 20%, no? 1.20 to the power 5
To the power 5, yes.
into 1.gn means 1.8%, 1.08. Isn't it?
Yes, sir.
Gn is 8%, g is 20%.
Yes, sir. Got it.
Mm.
Thank you, sir.
Sir, I'm getting a sum of 91.23.
Oh, no. Okay. 7. It should be 7.89.
7.89.
Okay, let's check the past. During high growth period, what have you done? Have you taken the ROE? What is the ROE you have taken? How much?
ROE is 25%.
Yeah, yes, into numerator. Good numerator. What is the payout ratio?
Payout ratio is 20%.
20%.
Into 1 plus G?
Into 1 plus G is 1.
1.2
Yes, 1.2.
into
So 1 minus 1.2 to the power of 5 divided by 1.115 to the power of 5.
whole divided by
1.115 minus
20.
0.2.
0.2. It's coming how much? Then comes the second part. During stable growth period, what are the figures? During stable growth period?
0.68
68.
multiplied
0.68
Into
to 1 plus
1.20 raised to 5
uh,
multiplied by 1.08
yes,
divided by 0.115 minus 0.08.
yes, into
1 plus
115.
115 to the power 5.
5
Yeah.
or 1.115 to the power
To the
5.
power 5. Yeah.
Is equal to how much?
89.97.
89.9. So whether you are wrong or I am wrong, I don't know. It's
Around
7.89.
4.9.
Eh?
Around 4.9.
No, 7.89. Can you check, please? Some
Checking
serious
it.
mistake. Yeah.
This is numerator. Denominator is okay.
Lamba formula, sir.
Sir, it is 30.29. That is
No,
what
no.
I'm getting, sir.
It's coming 7.89.
Is it the final output, sir?
Yes, final output.
Wait. Okay. Okay. So we have to sum it first. So it should be 1.2 plus 30, and we should get 31. After that, we have to multiply it by ROE, right? For price per PV. So it will be 7.887.
Yeah, 7.89, 7.88. Okay,
Yeah.
correct. Okay, but in EC3 you are allowed to take all the formulas, no?
Yeah.
Yes.
Sir, please upload the presentations to the site, sir.
I'll do it. No, I'll do it tonight. I'll do it. Last class I did it, isn't it?
No, sir, not the presentation. I don't see the presentation, sir.
Yes, last class I did. No, I have uploaded. No,
Yes,
last
sir.
class?
We have it up to third.
No.
Valuation third PDF we have.
You check the third one. You check
FCF.
third one. Something. No.
I just checked.
Something.
Let me check again because I thought the recordings are there, but not the PDFs.
No, PDF is there. Valuation
Sir,
1,
subjected
2,
up
3.
to valuation 3, session
Ah,
3.
3 is FCFP. They check.
Yeah, May 3rd. It's there, sir.
Yeah.
Thank you.
Yeah, it's there. Now today I'll do it this one. Tonight I'll do it, I think. Okay. Next. Can I proceed next, please? Price to sales. Or there's one more is there. Do you want to solve one more? Do you want to solve one more?
Okay, sir, we'll try.
Is it? Yeah.
Eh?
Okay, sir, we'll try.
Okay. Take this one. But this one already summary given, but in the exam this will not be given. You have to prepare like this. High growth period, stable growth period. Okay. Anyway, you see here. This company is a Mexican company. Okay. This company reported earnings growth of 49.53 between 87 and 92. Was expected to maintain the average growth rate of 40% a year in earnings from 93 to 2002. Beyond that point, the growth rate is expected to decline to 12%. Clear? And note that this growth rate are high in the nominal term but are reasonable given the inflation. The stock which was traded on the Mexican stock exchange at a beta of 1.11, 10-year bond rate in Mexico was 12%. The risk premium was 7.5%. This company paid out 4% earnings as dividend, 4% of its earning as dividend in 1992, but was expected to increase payout to 10% by 1993 and 60% for the stable growth period. ROE in 1992 was 28.72, was expected to decline 15% in the stable growth period.
Sir, in this one, there are three 5-year, there are two 5-year values. One is the
Yes.
growth of 49.53 and
Yeah.
next 5 we have 40.
Hmm.
So should this be considered a three-phase model? And after
No.
that, like it will be
No. This is not. These are two pairs. First, the high growth period is 10 years. We take it the high growth period as the 10 years.
what should be the growth, sir? We have
40,
here it is
40,
given as 40 percentage.
40.
But what is the purpose of 49.53?
It's a reported earnings growth 49.53 between 87 to 82 was expected to maintain a average growth rate. This is the average growth rate from 80, this for 10 years, this is the 40%. Only this from 87 to 92 is 49.53, but the average growth rate from 93 to 2002 is 40%.
That is only for the 5 years. The 40 percentage is applicable only for the first. So first 5 years, like it is 49.53. That's what I'm thinking. Like we should.
No. The past 5 years 49.53, but actually valuation starting from next 5. No, if you see the over the 10 years from 87 to 2002, the average growth rate is 40%. Here the high growth period is the 10 years.
Yeah, so N should be 10 years.
Yes.
Right?
Yes. N is the 10 years. The average growth that is from 93 to 2002 is the 40%. And beyond that, it means though this first 5 years of 49, but if you see the average, the next the 5 years is just 40%. You take that 40% as the growth rate. And expected length is your 10 years. Would be. You are doing?
Sir, war is over, sir.
Sorry?
War
War.
is over.
War
Yes,
is
sir.
over?
Yes, sir. There is a
Yes, sir.
ceasefire.
War is over.
The ceasefire. Oh, what happened? Who did?
America.
Donald Trump. Yeah. Hari Kishore.
Sorry, I don't know the news. What happened? Sorry, I don't know.
No, there is a ceasefire mediated by America between India and Pak.
Okay. What happened? The next?
I think they will keep quiet for a while.
Sir, is the final value 223.18?
No, finally is coming. Just wait. Final is coming 6.22.
Oh, somewhere I made a mistake.
Has to take 0.2872, that 28.72 ROE. Yes or no? First, 28.72, no ROE. Please tell me. At least you tell me yes or no.
Sorry, sir, I was talking on mute.
First, you take 28.72 into the 10%.
Yes, sir.
Into 1 plus G, 1.40.
Yes, sir.
Whole into 1 minus 1.40 to the power 10.
Yes.
Divided by 1.203333 to the power 10. Yes. Hello.
It's 2.52. This is very clear. Then there is a problem with this. Ratio 60.
I will post the solution. Just wait. I'm posting the solution. Just give me two minutes time.
This 10. This is also 10. The division is going to be this one. 10. I got 5.88, sir.
This is the solution. You can see my slide.
Yes, sir. We can see, sir.
Yeah.
Oh, it is 6.22.
6.22.
Okay, sir. Thank you, sir.
Okay.
Is 28.72. That is where the problem.
Please solve once more whatever we have done. Some additional, if you can get from also Damodaran side, you can solve few more, 1 or 2, not many, few more. It will be enough for you for EC3. Okay. The next class will start price to sales. Okay.
Yes, sir.
Okay. Next class price to sales plus how to prepare for EC3. Hello,
Okay,
you are
sir.
getting me?
Yes,
Yes
sir.
or no?
Yes,
Yes, sir. Yes, sir. Yes, sir.
Yes, sir. Yes,
Next
sir.
class will be price to sales, or sorry, price to revenue or sales net. Price to revenue or sales, similar constant growth and 2 stages. Then how to prepare for EC3. Okay, fine.
Okay,
Yeah.
sir. Okay,
Sure.
sir.
Okay, bye. Take care.
Thank you, sir.
Thank you,
Yes, sir.
sir. Thank you, sir.
Thank you.